Hello, I'm Joe Weisenthal.
And I'm Tracy Alloway.
We are the co-hosts of the Odd Lots podcast here at Bloomberg, and I'm psyched. We're going to be doing an episode of our podcast on stage with Dan Morehead, the CEO of Pantera Capital, which does VC and hedge fund type trading in the crypto blockchain universe. And we're just going to kick it off right away. So Dan, thank you so much for joining us.
Thanks.
All right, I have a question. I sort of ask it to everyone in the space, but so far, what we've seen over the last year in particular is if you look at a chart of cryptocurrencies, Bitcoin, Ethereum, it looks like the NASDAQ or something like that. When's that going to change? Why are we even talking about crypto as a distinct asset class if right now it just seems to sort of trade as tech stocks?
Yeah, that's the $64 million question, right?
More than that.
So for the first 10 years of crypto's life, it traded with 0.08 correlation to the S&P. Then in some big sell-offs over the last 4 or 5 years, it traded with a little bit of correlation, but for only 2 months. This time has been very different. Admittedly, it does look like the NASDAQ. It's been correlated for 8 months or whatever. I think it's starting to break down. If you squint and look at the graphs, it is starting to break down. And that's the big trade, in my opinion, that I think risk assets are still going to struggle for some reasons we might want to talk about. But I could see a world where blockchain does really well, even if the other risk assets are impacted. And the main reason is most of the normal asset classes are really connected to interest rates, right? Bonds are mathematically connected to interest rates. Stocks are discounted cash flows. The PE upside down, the earnings yield is very similar to an interest rate. And then, real estate obviously is connected to mortgage rates, to discount rates as well. Whereas, Bitcoin is like digital gold, right? There's no interest rate component to it. It should be able to trade independently. And it hasn't for the last 6 or 8 months, but I think it really can for the next, period of time.
So maybe expand on that point a little bit, because when I think about crypto and Bitcoin in particular, I kind of think of it as the ultimate momentum asset, like driven almost purely by sentiment. So when you're in an environment when it feels like risk assets are falling apart, I can see why that kind of bleeds through into crypto and Bitcoin again specifically. What exactly is going to change in terms of investor behavior to make that different?
Yeah, so I'd say in these little short cycles, it does feel like it's a high beta version of the NASDAQ or whatever. But it's on a 20-year secular bull market. And that's what you have to keep in mind is that over the last 10 years, every 2 years, the number of people using Bitcoin or cryptocurrencies generally has gone up an order of magnitude. If that keeps going, we go from 200 million people using crypto today to say 1 billion in 2, 3, 4 years, the price probably goes up, right? And it really is Econ 101, supply and demand. So no matter what happens with the 10-year note or with the S&P 500, if 1 billion people are using crypto in 3 or 4 years, it will be a lot higher. And that's why I'm so bullish on it.
Okay, but then this also gets to another question of what do you mean by use? Because most people who I think have some exposure to crypto are almost certainly their exposure is through speculation, probably keeping it in some sort of centralized custodial account as opposed to actually using the chain in some manner. So when you say 1 billion people are going to use it, what do you mean specifically, or what use cases beyond hoping to get rich quick do you see taking off, making up that 1 billion?
Before I answer that, I want to give you one cool stat on this Q3. The decoupling of crypto. So the S&P was down 4.9% in Q3. Bonds are down 8.2%. As Boaz just said, it's both are down when they're supposed to be anti-correlated. Gold down 7.9%. The Bloomberg Galaxy Crypto Index is up 16%. So it is starting to happen.
Right,
and again, good news doesn't.
What was the time frame of that?
Q3.
Okay.
Yeah, so good news doesn't really sell, but that is the good news. So it is starting to happen. And since the lows, Ethereum's up, 40%. A bunch of protocols are up a lot since the lows, whereas the S&P is, still near the lows. So the question is it all speculation? It's not. There are some, people that do speculate in crypto, and admittedly, it's so revolutionary. It does get overhyped, right? And it's going to change the world overnight. It's going to, do things that is going to take 10 or 20 years to do. But the reality is, lots of people use crypto to store their wealth, to move money across borders. A good example is 10% of all U.S. to Mexico remittance goes over Bitcoin already. That is a great development for the world. the average remittance cost in the world is 8%. And for us in finance, that's just a number, right? 800 basis points. For the migrant, that's a month's wages. I mean, they spend an entire month working to pay the remittance company, and their family only gets 11 months of their wages. If you use Bitcoin or another cryptocurrency, you can send it to anybody on earth with a smartphone. And that's why I'm so bullish, is there's 4 billion people that have a smartphone, and that's the only thing it takes to operate Bitcoin, right? And so, it'll take, 3 or 4 years to get to 1 billion, but I think it's pretty inevitable. And so that's why I'm so bullish. There's so many different use cases beyond just speculation.
All right.
So before Pantera, you worked at Tiger. You were also a bond trader at Goldman Sachs, I believe. So you have this extensive macro background. What was the transition like from macro to crypto? And are there parallels between being, a bond trader and being someone who's in crypto, primarily investing through venture capital and tokens and things like that?
It's actually very similar, and it's not a coincidence that a lot of the people in the crypto industry are kind of retread macro traders, because macro is all about looking for asymmetric trades around the world that are going to, have way more upside than downside. And over the decades, there's been things like Russian privatization or Argentine farmland or Tesla Motors or whatever, and those things are all really cool trades, really interesting, but they're just specific to either one region, one asset class or whatever. And Bitcoin and blockchain are going to change so many different things, and literally for billions of people, and it's borderless. It operates in any country. So it's just the biggest trade in a generation. I think it's kind of the second half of the internet. So it's kind of equal in its importance to the other protocols that made the internet work. And the reason to be involved in it is it's just going to disrupt so many different things that even if we're wrong on like a couple of them and those don't work, it's got so many other use cases that it is a really strong macro style trade. And again, macro was kind of dead for a while. Rates were at zero everywhere, and kind of nothing interesting on the policy front happened.
Right. I remember people complaining about the lack of volatility in the markets, and here it is.
In retrospect, we shouldn't have complained so much.
Yeah.
That was those were the good times.
Yeah, no, macro's back, right? Like there are so many crazy things. Like the Bank of England, it's tightening and easing at the same time. That's wild, right? Like so, there's a lot of kind of tectonic shifts that are happening here, and that's where great opportunities come. Things are actually really moving.
I want to ask another question about correlation that I think about a lot. Okay, we talked about cryptos or Bitcoin's correlation to the NASDAQ. Intra-crypto correlation. If you look at a chart of Bitcoin and Ethereum, culturally it's sort of like there are all kinds of reasons they've become very different assets. At least it seems to me. And one, digital gold, the other one's sort of this platform for distributed computing, all kinds of differences. Yet even those charts basically look the same. When are we going to see sort of more discrimination, perhaps, within crypto so that, I don't look at a page and it's all green and it's all red one day? It still seems like everything is just beta to Bitcoin or beta to Ethereum.
It seems like that, but if you actually look at the numbers, it isn't, right?
Okay.
So Bitcoin is very close to its low of June 18th, but Ethereum's up 42%. Uniswap's up 90% since the lows.
That's not just the sort of crypto beta, like general.
They're positively correlated, right? Like I'm not saying that some are going to go way down, some way up, but with Bitcoin not doing much over the last 4 months, some of the other protocols are really ripping. And I guess the important thing to stress for investors is there was a time that Bitcoin was everything, and all you had to do is put your money in Bitcoin, and that was it. And then there was a time you kind of put half in Bitcoin, half in Ethereum, and you were fine, right? Now a huge amount of the kind of the value creation is coming in other projects, and it's not surprising. It's like there wasn't one company that became the internet, right? There's a lot of important internet companies, so there will be quite a number of important protocols.
I want to go back to the use case question because I believe you started your interest in crypto in 2013, which is relatively early.
Super early.
Yeah, I started writing about Bitcoin in the same year. And I remember people being excited about blockchain technologies. This was going to change the world. And, a little less than a decade on, it feels like we're still sometimes talking about hypotheticals. So inroads have been made, but certainly when it comes to blockchain tech, DeFi, the whole Web3 idea, it's still sort of a thing that's on the horizon. So A, if the technology is this revolutionary, why isn't adoption happening faster? And then B, how do you actually evaluate these various projects and tokens, given that often the use case is, far off into the future?
Yeah, so there's a lot of people that are negative about crypto, and it's kind of like in the 90s sitting there with the 8K baud modem in your bedroom screeching, going, the internet sucks. It did suck in the early 90s, but now they built out a lot of really cool stuff, and the internet's important. So that's the way to think about crypto, is it does some things really well. It's really good for storing your wealth. It's really good for moving money across borders. So there's already, tens of millions of migrants that are using Bitcoin. But some of the, like property titles on the blockchain haven't happened, those kinds of things. Doesn't mean they won't happen. And so that's the perspective, is that each of these things will happen sequentially. And I'm pretty amazed. There's 200 million people using blockchain, right? That's a pretty big thing. So each of these use cases is getting rolled out in its own time. And there are certain things, like someday all of Wall Street's back office is going to be on a blockchain, right? But that's going to take like 20 years because it's very complicated.
Some of them are still using COBOL and stuff
Exactly,
invented
yeah.
from the 1950s.
No. I saw there was a huge boom in COBOL engineers, trying to.
Why is that? Because, one of the things about, distributed ledger technology, blockchain, whatever you want to call it, the way I think about it, and tell me if I'm wrong, is that there's a certain you pay, because it's distributed, there's a certain increased computational cost, but because the advantage is that maybe it's censorship resistant, it's permission free. Why do you anticipate that cost will be worth it for Wall Street banks, such that all of finance will be on a chain?
Oh, I'm saying that's a 10 or 20 year thing.
No, but even in 10 or 20 years, like, why is that a superior architecture for finance than the sort of ultra fast, ultra cheap centralized databases?
Because there's like 1,000 different databases that have to be reconciled all the time. So if you had a one blockchain solution, you'd have a timestamped thing where all the data resides in one spot. But that is way down the road. The thing that's actually happening now is Web3. I think that's a great concept. That we're used to all these internet companies doing cool things like sharing music, social networking, all that stuff. But they're really expensive. They suck an enormous amount of the value out of the equation, and the contributors often get very little, or in social networks, zero. The people that contribute all the value. And Web3, I think, is one of the most inevitable trades I've ever seen. We might be early, it might take longer than we're thinking, but having decentralized versions of all the companies we're used to, like Airbnb or Spotify, having a decentralized version is way better. You're right, it's a little more expensive maybe to maintain data on a blockchain, but you're not paying the 20 or 30% rent that the equity-owned companies are doing. And you're already seeing use cases like music sharing. Audius is a project that we've been invested in. It's connecting artists directly with the consumers, which is way better than having some entity taking 20 or 30% out of the middle. And then the really cool thing is the people that are engaged and contributing to the network. The kid that's on his phone finding new bands and upvoting them gets paid a little bit of the network's value. And so the more you contribute, either as a recording artist or even as a fan, you get to own a chunk of the network. There's already 8 million active users, so it really is taking off. And the other benefit of Web3 is not just being cooperatively owned, it's ultimately being cooperatively governed. And there's some governance issues with some of the big entities out there. And so having the community itself, decide how to, who can use it, how they can use it, ultimately I think this would be way better than our centrally controlled Web 2 companies.
So this actually leads into something I wanted to ask you, but if you are a crypto investor, which you clearly are, you can invest in the space in different ways. So you can buy equity in a crypto startup, or you could buy the token, which might come with some sort of use benefit or governance participation through a DAO or something like that. How do you evaluate the way in which you gain exposure to these different projects?
Yeah, so that's a super important point, is that when the internet came around, you couldn't buy a chunk of TCP/IP or other protocols. The only way to get exposure was buying equity like Pets.com or whatever. So here you can do that. You can invest in venture equity, but you can also buy a chunk of the protocol. And so I think it's really important, and for our advice to investors is to have some exposure to the protocols themselves and some exposure to venture equity. The protocols have generated most of the value. So Bitcoin, Ethereum have way more value than the sum of all the equity companies in the space, but they have different characteristics. So I think a great portfolio is some of both. And then the specific question is now, like back in the day, things were either a token or equity. Like Bitcoin was just a token, it was never gonna have equity. And then things that were venture startups would rarely have tokens. Now there's a lot of projects that have both. And admittedly, it's hard to tell sometimes where the value is gonna accrue. And so the industry typically, and we do as well, typically buys both in a project so that if 10 years from now we found out that most of the value went to the token, that's fine, or to the equity, it's fine.
Do you see several layer one chains?
Yeah, so that's a great
What does
question.
the future look like?
Yeah, I think so. And there's a lot of
Why?
religious people out there that want it to be just one. Well, there's lots of different use cases, and it's kind of like, again, going to the internet analog. There isn't just one internet company. There's a bunch of different things, and there's a bunch of different companies. And so the same thing here is there are different attributes that people want in layer ones. We mentioned digital gold, Bitcoin. It's really good at storing wealth. It's really good at moving money across borders. It doesn't do other things, right? That's its virtue or its vice, whichever perspective you have on that. And Ethereum's really good at smart contracts, but its throughput isn't that great. And so if you're going to store an enormous amount of money, you probably want to store it on Bitcoin. If you just want to play video game and don't really care about security, you might want to use Solana, right? So I think there's going to be something like 10 important layer ones in the long run, each doing their own thing. And again, that's like the internet. It's easy to see a world with 10 or so. The one thing I would say is it's not going to be like 5,000. And so there will be a kind of single digit number of layer ones.
So we are going through a crypto winter, which is kind of an expression I hate, but a crypto bear market at the moment. What advice do you have for investors, many of whom would have probably bought at the top and are not now facing losses? Oh, and also, sorry, can I just tack on to that? What's it like actually fundraising for blockchain-related projects in that environment? Because you are raising money at the moment for a big new fund.
Yeah, so human nature is very pro-cyclical. Everybody wants to buy at the top, and not that many people want to buy at the bottom. And we've been doing this for 10 years. This is our third massive bear market in those 10 years. And yeah, inflows were booming in February, March, and they kind of have dried up right now. So the advice would be buy low, sell high. And
you make it sound easy.
It's just so hard because when it's at an all-time high and everybody's on TV talking about Bitcoin, the FOMO devil's whispering in your ear is really easy to want to buy. And then coming home to tell your spouse you want to put a lot of money into Bitcoin today doesn't sound very fun, right? So, but it is probably a great time because all the fundamentals are happening. The Fed's building a blockchain. China has 200 million people using a blockchain. The oldest bank in the United States, Alexander Hamilton, built Bank of New York, and he's selling Bitcoins now, right? They're storing Bitcoins now. So, things really, all the fundamentals are great. It's just it got caught up in the risk reduction. And I would say one of the reasons why crypto's price looks kind of like the NASDAQ is there was excessive leverage in our industry. There were some centralized finance companies that, just old school banks just borrowed too much, lent to things that didn't work, and got liquidated. And I think, unfortunately, that kind of caught up crypto and made it look like it was more connected to the NASDAQ than it really should be. It was really just over leveraged in our system. And the important point to make there is there's kind of a narrative out there that DeFi failed, like it didn't work. DeFi worked great, like Aave, Compound, all those things, process transactions 24/7 without anything ever going wrong. It was centralized finance protocols. There's the companies that ultimately didn't work.
So this actually leads nicely to a question we have from the audience, and do keep sending those in. So someone asks, are the nonstop new coins being developed helping or hurting the industry? And I'm just going to rephrase that slightly, but you mentioned some of the froth going out of the market over the past year. Like, is that all gone? Are we in a healthier place now, or is there still another shoe to drop given the volatility that we've seen in traditional assets and what's going on with interest rates?
Yeah, it's a great question. And the distinction I would make is most of these aren't new coins. And so people, they're not layer ones or blockchains themselves or cryptocurrencies. And one thing that sometimes people get wrong is to say, hey, we don't need 5,000 new currencies. And that's been said in the official sector here in the U.S. The loss is that we only need about 10. There's about 10 blockchains that we need. But most of the projects that we're excited about are really just applications, like digital companies that are built on top of Ethereum or Solana. They're like companies that are being built on top of other applications. And we have 4,500 public companies in America, right? We could easily have 4,500, tokens. So I don't think there's any kind of problem with the number. Yeah, in the bull markets, more money gets raised to projects that probably don't make a ton of sense. And so these times are better because very few projects actually get funded, and most of those are really good. And we saw, we closed our last, or invested our last venture fund in 2018 and 19, right, in the last crypto winter. And that was awesome. All those investments did incredibly well. So I think over the next couple of years, it's probably a great time to invest.
So speaking of use cases and so forth, there is a poll that is flashing up there. So if you scan your phone on the QR code, you can vote on areas of crypto do you find most compelling. But I want to ask you, you said you liken the new projects that you're investing in to the 4,500 listed companies. Are they companies, and are tokens securities, and should they be treated by regulators as such?
Loaded question.
No, it's a key question. But
So it is a good question. They are like digital companies, but they have a lot of different characteristics, like collective cooperative governance and all those things. And I am absolutely not going to do a Howey test rundown, here, because it is. I admit it's very hard to apply 1930s regulatory frameworks to unbelievably wild new technologies like DLT, right? So it is difficult. I know there is a case pending with Ripple and the SEC, so we'll find out at least if one's a security or not soon. But it's tricky to try and say whether these incredibly new technologies are either in or out of some 1930s regulatory frameworks.
What would you like to see ideally from regulators? How should they approach the space? I mean, again, considering that they have a mandate for financial stability or for consumer protection, so they do have to put some oversight on the space. But what would you ideally have them do?
Yeah, so first I'd say that at least in the United States, the glass is 7/8 full, right? Like 7 out of the 8 bodies have already ruled, and ruled great. The IRS ruled in 2013 that crypto is not a currency, it's properties. You get long-term capital gains tax treatment. The CFTC has been incredibly progressive, been engaged in crypto since 2013, their futures in 2017. So most of the regulatory bodies have ruled. And so really it's the SEC in the United States that's left. I would say that clarity would be very helpful for our industry, that most players really want to execute business in a way that is acceptable. And so if there were more clarity, I think that would be good for our industry. And then globally, there are a handful of countries that have been very progressive in trying to foster development of, I think, it's a massive future industry. So it'd be great to have that industry develop in the United States. And that is actually a big distinction. The U.S. literally built the internet with DARPANET, and then gave incredible benefits to internet companies, right? They exempted Amazon from 8.25% sales tax for a long time, and they gave them a huge advantage over the bricks and mortar store right next to everybody. And so all the big internet companies ended up in the United States. As a U.S. citizen, I think that's great. I would love to see that in crypto. The reality is the regulatory regime is scary, and 19 out of the top 20 protocols reside outside the United States now. And the last one's the one that's in a lawsuit with the SEC. So, it'd be great to keep it onshore. And the important point for regulators is whether they like blockchain or not, it's happening. And you're not going to get the toothpaste back in the tube. So it'd be better to have it, onshore rather than offshore.
So I want to ask a question, and I think it kind of dovetails with the question of, are there too many coins? But it has to do with incentives, because one thing that I think about crypto is that a lot of people have made an extraordinary amount of money, and in many cases without having like created the killer app or created a ton of consumer value. And it seems also like in many cases there are opportunities to make like a fortune in a very short period of time without necessarily having the project play out. Is that the case, or is my perception off? And would it be better if there was some sort of restructuring of incentives that it would encourage more sort of like long-term creation building or payoffs that were further down the road after some sort of a clear consumer surplus or use case had been demonstrated?
Well, I mean, I think the reality is most projects, there's been 5,000 things launched over the years, and most haven't worked and have been bad for speculation. So it's not like, hey, everything just goes up. And so, so the good projects do get funded and ultimately do have traction and have, lots of people using them. And there is value. And it kind of is creative destruction. Like the internet, a lot of projects didn't work, but the ones that, persisted have a ton of value.
I want to go back to the macro environment in general, and I have a good segue into this, which is I was trying to chart the volatility of some long-dated UK inflation-linked gilts yesterday versus Bitcoin. The linkers are much more volatile than crypto now, which probably says more about the environment for bonds and duration and what's going on with the BOE than it does about Bitcoin, but still kind of interesting. How long is this environment going to go on for? Is there a bottom in sight for traditional assets such as stocks and bonds?
So that is an important question. I think it's a lot longer from now than most people think. And I know that's hard to hear, but we had a 42-year bull market in rates that bailed out everything else, right? Stocks, real estate, everything's been going up. Rates started rallying in 1982. And I think we're just used to, well, any boo-boo that the stock market has or, the housing market has, well, the Fed will just cut rates and that'll fix it. And it fixed a lot of things for a long time. Rates got to zero, potentially for too long. And now there's just unfortunately a lot of unwinding that has to happen. So I wish this weren't true, but my professional opinion, I think, is that bonds and risk assets probably struggle for a period longer than a couple days, which is what most of us hope for.
Well, you mentioned, and an audience member is asking about bringing money back into DeFi space specifically. But you mentioned that there's there's cryptocurrencies that are very different than equities or traditional risk assets, but some kind of do see the same, and you have like a certain level of like cash flow or implied cash flow in a lot of these. So, what will bring these sort of areas of crypto that kind of resemble stocks or kind of resemble bonds or traditional finance? Will they struggle as long as risk assets do? Or is there some other catalyst that would say bring money into the DeFi space, even if bonds and stocks, et cetera, continue to struggle?
Yeah, I think the story is that, we're on this long secular thing, pulling potentially billions of people into crypto. And that kind of bails out all the little cyclical issues. And a way to think about it is fun new things like NFTs and gaming are now bringing enormous amounts of people into the blockchain space. And that just creates more demand, more people using it. And again, if I'm right in that, 3-4 years from now, 1 billion people are using blockchain, it probably has to be higher no matter what happened to the S&P. If you're having that many people buy something, there's a fixed quantity of, right? There's 21 million shares.
You're always making new monkey pictures though, right? Or NFTs.
Yeah.
Okay.
If the Fed were to pivot, within the next year or something and interest rates start to go down, would that be good or bad for crypto, given that ostensibly you do want to see it start to decouple from rates?
No, it would definitely be good. I remember vividly in March of 2020 when the pandemic policy response was starting to happen, we sent out our investor letter super bullish on crypto because printing all that money had to be incredibly positive for anything with a fixed quantity. It was going to be great for real estate. It was going to be great for Bitcoin, whatever. So if the Fed did pivot and went the other way from where I think they're going to go, it is definitely very good for crypto. My only point would be, even if they keep hiking, I think crypto can still do well. Because investors have to put money somewhere, right? And most institutions are kind of triaging their portfolio right now, trying to figure out what just happened. Obviously, a big paradigm shift happened, and trying to figure out, how much damage to their various portfolios. But when they actually start thinking about where to put money to work, and they look at, rates are rising, and I think they're going to rise quite a bit more, so that'll hurt equities. Blockchain can trade independently, and with a lot of projects already up 40 or 50% since the lows, it's starting to show a little bit of promise for where people could put money to work and be safe.